All right, so welcome you all once again to Target Professional Consults and the entire team Target. Today is our very first meeting for financial management, and we are going to look out for the very first section. And let's all try. In fact, this is Target, the team leader, Target Professional Consults, and we'll be taking you through financial management. It's actually a consortium which we have a team leader and the entire team being a support staff. All right, so this is financial management. I'll first of all walk you through how the interface works, how our digital platform works, how our books have been arranged. So that is what I'll do. And we move on with the game. So first, we now have to start the game. So please, if I'm not on the page, I'll quickly add you. Yes, I'll quickly add you to the financial management page. I'll quickly add you to financial management page. And then that is all about it. So let's go straight. All right, so this is how the interface have to be. So make sure that you can access all these materials with you. Now, right after the section, I'll now start talking about the actual do's and don'ts. What you have to do. Please, financial management, it's a bit analytical calculation. You explain the numbers you've calculated. So it's not order management, but it's management with figures. Let's take notice of this. Now, kindly have the interface. This platform is virtually new platform, not the old one. Now, you must have access to this. And I think check your email. If your email is not part of the ones listed here, it means that you don't have access. So if your email is not here, you don't have access. So let me add one more to it. Good. So kindly check your mail now. You receive a folder and now you have access. Good. Now let's open into our digital platform, the Target Digital Library. Please, first thing, have access to the books and notes. Lecture books are here. Let me start from the old books. The old books are very good. Old ACCA, please. Let me be very truthful to you. This platform is for both ACCA, ICA, and CIMA. And ICA Ghana, you cannot answer your question without ACCA. All the questions that came from all the 14 papers, with the exception of public sector and business law. Public sector and business law. So the 12 papers left, virtually. And then taxation, virtually. All the questions are coming from ACCA. Yes. So please take notes. So that when we put ACCA materials there, you can also use that. And then it's very helpful. So that's why on our digital platform, all the digital platform, we have ACCA materials as well as ICA material in one folder for you. Obviously, if you want to do it alone, you should have go to several sites, but here just in one folder, you have all these two important documents with you. So let me go to ICA Ghana first. So this is the ICA Ghana, our old textbook. You open it and then you help yourself. This ICA Ghana old textbook, not the new one. Then we go back. When I go back, I have ACCA, that one. I have a lot of ACCA textbooks for you. One, I have the ACCA BPP 2019. This was one of their latest book. Yeah, 2019, one of the latest book for BPP. Again, I have another BPP book 2017. Again, there's a Kaplan. I've not added a Kaplan to it. And there's Emily Wolf. This is Emily Wolf 2013. And this book is virtually the same as ICA current book. If you pick the ICA Ghana, the new book, and the text in this are basically the same because it is written by the same team. It's the same Emily Wolf who wrote ICA current book. They are the same who wrote our book. And this book is doing magic in town. You have access to it freely. All these are in here. This is the same as ICA current course outline in the book. So you have it. And I call this old book. I still call it what? Old book, not even a new book. Now let's go to the new books. I have the ICA manual. This is the ICA manual, the new book. It's also here. You see the topics, they are also here nicely. Please make good use of this. And we are going to update this platform every single day. Update will be going on. The other that we have lecture notes. Target, I've added my lecture note for you. So for the very first topic, the nature. Today we are doing nature and purpose of financial management. That's chapter 1. You must get it. I'll be arranging it for you. So get it here for me. And that's all. You see, all the topics will be uploaded here. Then right after the books and notes, lecture notes, we now go to lecture videos and notes. So far, we've done only one. Just the intro. And then the syllabus is over here, the course outline for our presentation. This course outline for presentation. In fact, our course outline is the same because we've not changed the syllabus. So these are the course outline. I'll go through with you and then we'll move on with the game. So you see, our target is always 55. No wonder we are streaming live from Studio 55.5. Yes, so that is that. From there, we have not left you the same. No. We have given you powerful questions and their answers. Happy yourself. Now the questions, I have 3 different forms of questions. First of all, ACCA past questions. They are here with their solutions. Very soon, our system is going to segregate each of the questions into topics. And we will produce that one very soon for you before your exams. That one makes learning very easy. Now, these questions, ICA Ghana normally go there and pick questions from. Every question you see has solution. Come here and arrange it. So I pick one of the ACCA parts. So this is June 2014 financial management. June 2014. Oh, you are? Yeah. Should I show you this question? This question has dropped in ICA Ghana 2 times. 1, 2. This question has dropped 2 times. Yes, it's an MPV question. Just I open 1 has dropped. That day they asked them to do sensitivity analysis, and they should do MPV and then the rest, and capital rationing. Yeah, he asked them to take notice of this important material. From there, you must also go to ICA past question, living legend. I have from 2010 up to the last sentence question. You must also take notice of that one. 2010 to last sentence exams. It's also there with their solutions. Don't need to look anywhere but this. Then I've also given you question banks. Oh. Yeah, ACCA question bank for financial management has also been uploaded for you. Here to be here 24/7. So all of them are here. The last one I'll talk about is target questions. I've also compiled questions for you, and they are very powerful. So you saw that I dropped one of the questions on our page, I think this evening. The question I dropped on the page was on tutorial questions on environment, in which last sentence question came from that. So this is the one I dropped on the page. There are more in here that I'll be dropping. So for materials for your pass, we do have. There's no way IC examiner will set questions on the environment, which will be outside this. I normally have question 80 to question 20. That is where normally your question drops from. So take notice of that. I'm done. If you are not on this digital page, just let me know. I'll add you as soon as possible. Drop your mail. I'll add you. If you don't have access, kindly let me know. I'll drop you. Okay, so we are done with the game, and we'll move on. Let me see here. Yes, the videos on financial management were not on the YouTube there. Yes, I think only one video page on YouTube. The rest are on our old digital platform. So I'll get you the link and link it to it, and then we move with it. So I'm done. Question time, understanding time before I go straight to the course itself. Now let's start the course itself. So what are the program itself? Maybe I may be streaming this to over there. Now let's go to the main game. First, we have to talk about financial management. You see, I always start this program by telling you the genesis, by always anything we learn in accounting professional, ACCA, ICA, CIMA, the idea is to create qualified accountants in the industry. Good. So we always start from accounting. What is accounting? Why do we learn accounting? So if we should trace the root of accounting, I always say that accounting means what? Provision of information. And one of the information that we can provide is on financials. So we call it financial information. Financial or money. Information about the money. Now, to get information about the money, then there are two issues here when you talk about money or financials. We have teams that manage the money, teams that manage it. So they manage the money, management. And we have teams that they report. So we call it reporting. So no wonder we have a paper called Financial Management and Financial Reporting. One reports on money and one manages money. So whom do you think his work is more tedious, more difficult? Is it the one managing it or the one that only reporting on it? You tell you clearly that financial management is a bit detailed than financial reporting. And I always say that financial managers understand financial reporting much more than financial reporters. And I have a deeper explanation for this. If you follow us to the end of the storyline, you'll get to know all these things very clear. But before you can get access to our digital platform, you have to first of all register with us. We get your email address. You are free to go. You have access to this. All right, so now we move on with the storyline. So managing money is what we are going to learn. And when we say we are going to manage money, not only money, anything in the form of money or anything we use money to buy. So management of money in a sense that it's about where we get the money, efficient means of raising money, and efficient means of what? Disbursing this money. That's all. Efficient means of what? Raising money. Yes. And then how we can also spend this money wisely. That's the essence of management. There's something that calls for management. So always take notice that there's something that calls for management. Management comes in when there's a scarcity and you want to utilize resources. So these are the two reasons why we have to manage. So if you fear that what you have may get exhausted, then you have to manage it. If you don't fear, even you want what you have now to vanish, you don't manage it. It's like they've awarded you that, they've informed you all the funds that the entity has can be used in the future without getting exhausted. Oh, what a wow. In that case, what do? Do you manage it? No need. So in short, management comes in when we want to achieve efficient utilization. In addition, when there is what? Scarcity. Meaning when resources are not enough. That is where we think about what? Managing what we have for now. So if what you have is enough and you don't need to achieve efficiency, the management might not be of important. You get that? Good. So take notice of that. Now, management here is just about managing the financial resources to achieve a financial management. That's all. So financial management, FM, here is about managing your financial resources. Two things. Third examiner that, Mr. Examiner, financial management. Simple means managing the financial resources to achieve what? To achieve what you call financial objective. Of course, you cannot manage finance and expect to achieve something else. You can never plant maize and expect to harvest banana. It won't work. So you manage your financial resources, you get your financial objective cleared. And that is financial management. Let me be very, very topical, and let me be very straightforward. Let me go straightforward to you. I'll go through the course outline, the content, and I will summarize all the topic for you. So first, let me go to the content, and I will summarize everything. Now for probably ICA Ghana and ACCA, the content are basically the same, with the exception of only two topics that differentiate ICA from ACCA. And it's very clear here. So let's go straight to the game. ICA Ghana have two additional concepts, even though ACCA, it does not stand alone. So I'll go straight to the game and talk about it. Now, the very first topic will be coming from environment for financial management. That's the very first concept. Over here, we are interested in the meaning, the objective, the steps, and a whole lot of issues with financial management. That's what we are interested in. So basically, it's from the basis, the introduction, the purpose of financial management, and some regulations. So some regulations, you see? How does actions of certain regulatory bodies affect financial management? Such as Bank of Ghana, the central bank of your country. What will be their actions? How will their actions affect a financial management? Don't forget that financial manager, one of our role is to secure a very good finance, loans, an investment plan for the company. If your central bank, for example, Bank of Ghana or Bank of Sierra Leone, if it imposes, it reduces, it increases the base rate, the interest rate, will it encourage you or it rather discourage you? That is what we are going to talk about. What about the National Pensions Authority? What about the Insurance Commission? What about the Security and Exchange Commission? Especially if your company is what? It's a listed company. If your company is a listed company, then Security and Exchange Commission, you have to probably, in fact, look out for their actions and its effects on your business. Imagine you want to float shares onto the stock markets, or you want to float your security, some of your bonds on the stock market because you're a listed company. How will the actions of SEC affect you? You see, there's a company in the country known as Men's Gold. Realize that they were having issues with the regulatory bodies because they never considered the action, the impact that the regulatory bodies has on their business. So it's all part of the environment. What are the issues that may affect our role as a financial manager? What are the things that may affect you? The economy can shrink, economy can expand. How will it affect you? With the ACCA at this side, because ACCA is a bit international, we don't look out for one, we look for the international regulatory agencies or the international financial institutions, such as what? World Bank, IMF. Actions of IMF, how does it affect multinational companies? And then the individual companies. That is that. All right, so basically, we are done with the storyline. So that one, you will get it for 10 marks. And with target, target is saying that, please again. Score 7 out of 10 is basically theory. And then the entire question may be released from what we display on the page. Then move on to the next one is a financing decision. I'll come back, I'll talk about it later. Let me talk about time value of money. This time value of money talks about discounting. So it's one of the difference between the IC and the ACCA. With the ACCA, the time value of money is embedded in, we call it discounted cash flow. So that one is part of the investment appraisal. But with ICA Ghana, it's been asked on its own. It's a standalone topic. But with ACCA, it's just a subset of the investment appraiser. So for those who are offering ACCA, basically the same. Now let me go to the B, financing decisions. There's a source of funds. And that is where you have cost of capital, the WACC, and its related matters are coming from the WACC. So one of the main rules basically performed by the financial managers is to critically assess the best finance decision. We call it optimum financing decisions or optimum capital structure of a firm. So it's 15 marks. Don't worry. Give us 9. 9 is fine. Time value of money, give us 7. And investment appraiser, yes, capital budgeting. That one give us 8 out of the 15 marks. Financial risk management. Yes, risk management talks about, here we will not go deeper. We only talk about the foreign currency risks and then the interest rate risks and how to hedge them. So these are the 2 types of risks we are going to look out for. And then they are very important. Working capital management, yes, it's one of the troublesome issues. So you can look at it with critical eye, working capital management. And aside that, you have to also look out for business valuation, mergers and acquisition. There's acquisition here, 20 marks. The target marks, that's what you must score in exams. At least our target is 55.5. And I know very sure that you will score much more than that. And we move on with the storyline. I'm done with the game. Now let me start the whole storyline on the financial management. Now, financial management, there's one section about it that we have to look out for. You see? Now, I made a comment at the initial stage of the class that a financial manager knows, in fact, have in-depth knowledge on the balance sheet, the financial position, much more than the financial accountant or the financial reporter. Yes. Why? I'm going to explain that. Financial manager is responsible for everything on the balance sheet. Take notice. Financial manager is responsible for everything that you see on the balance sheet. But the financial accountant or the chief reporter, they are only responsible for the recording and to pass ledger entries. I'm talking about who is behind the acquisition of assets. It is the duty of the financial manager to get the right type of PPE, the right type of what? Asset that the company wants. They know when exactly to replace assets, unlike the financial accountant. So after financial manager have signed towards the acquisition of the new plant, and when the acquisition arrived, when the plant arrived, that is where the accountant take his very long pen, in the olden days, long pen to record that we bought what plant. But meanwhile, before this plant came, the financial manager have done analysis and find out the kind of benefit they are going to receive. So that's why I make a statement, and I always stand by it, that financial manager knows more when it comes to balance sheets, much more than the accountant. So take notice of that. And as a result of that, I'm going to explain why I'm saying, even though I've explained more, let me give you more insight. You see, financial management is coming from here. So sources of financial management, the source where financial management is coming from. What are the accounting equations? There are two accounting equations, two forms. So accounting equation. There are two main ones, even though there are varieties. The very first one is called the total asset method. Total asset method. That one, we say asset is equal to equity plus liabilities. Now let me talk about the second one. That is what I want to explain. The second method. You see, the second method is asset minus liabilities is equal to what? Equity plus, that one is called net asset method. Sorry, let me write the name. We call it net asset method. Net asset method. net asset method. That one, we say asset is equal minus liability minus the. Let's make it let me break it down more. I want to break it down more. Non-current assets plus working capital is now equal to equity plus non-current liability. Good. So for financial management, these are your topic. That's also net asset method. We get the entire financial management from here. Now let me do the real analysis for you. If we are to say that non-current assets plus working capital is equal to equity plus non-current liability. Now, all these are topics. This is topic number 1, capital budgeting or investment appraisal. Investment appraisal is all about buying non-current assets. That's all. Capital expenditure. That's all. So it is the decision of a financial manager to prepare his analysis or report on when, how to acquire non-current assets. And it's the responsibility of the accountant to pass the right entry to record this. To pass the right entry to record this. So that is that. Good. So the financial manager knows the effect before he bought it. He knows that it will increase gearing. He knows that the balance sheet will still balance before he acquired it. So that is how financial manager probably go to. And then that is it. Good. And then we move on with the game. All right, so that is that. Now, this is number 1. This is investment appraiser. So this one is investment appraiser, a full topic on its own. The working capital is also another topic on its own. Then these two, they are full topic on their own. Here you can get two different topics. The first one is called business, in fact, source of finance. A topic called sources of what? Finance. And the same place you can get what we call business valuation. And this is 15 marks and this is 20 marks, making 35 marks. So issues about equity and non-current liability on the balance sheet is 35 marks in financial management. You see, we are interested in its effect on the balance sheet. Take note, as a financial manager, we are only interested on its effect so that it will inform us as to what decision we must take. The financial accountant, don't forget, he is only there to record, report, and render proper account. So that anytime a financial manager wants to go and buy, I pick the last balance sheet prepared and just add the extra machines I'm going to buy, depreciate them, and see their net impact on the balance sheet. Before, in the next board meeting, I will suggest to the board that based on my own analysis, I think the new machine will improve the company's financial stand, the balance sheet very well, and I will defend it well. That is it. So that is how, please, finance goes beyond accounting, even though it's a subset of accounting. Finance is very critical and it's an interesting field that it have a very deeper accounting just go and end. Accounting will go and end. Finance doesn't go and end. No. Finance, all financial managers think about the future, present, and the past. But all accountants think about the past because they only record history. What has happened yesterday, that's what they can record it today. Or what just happened, they can record it. But they can't tell us what is happening currently and what's going to happen in the future date. So at the end of the day, it makes them a very like backwards minded or historical. Unlike financials that look into the future as well, make financial projections, focus into the future. So take note of the finance aspects. It's a very critical rule that you could probably explore a lot in them. All right, so basically that is that. Then you cannot practice financial management without the extra topic like risk assessment, risk management, and maybe the introduction, the intro. That's the environment. So basically, the entire topic I wrote down is what we are discussing. So when I make a statement as a financial manager, hey, you should know balance sheet much more than a financial accountant. He only record. You know the mathematics that you can do to balance it. You know that this, you can even write it again. And it's so balanced. And then that is all. You know that at any point in time, when you increase here by 20 million, you can share the 20 million here, 50 million here, and 5 million here. It will make it look good. But what will be its impact? What if you rather increase this by 20 million and you share? What will be the impact? That is what we are interested in as a financial manager. Then after we have initiated the transaction, the accountant now pick it. I'm done. Now I can start the financial management program itself. I've spoke a lot about it into why it came from and where we're heading towards. Now, let's start the main section. When you talk about financial management, it's just about managing the financial of the entity to achieve a financial objective. That is it. So when I manage the finances of the entity, in order to achieve what? Financial objective is what we refer to as financial management. I am only managing. And the word managing simply means efficient use of resources. Efficient use of resources. That's the word management. So efficient use of what? Financial resources to achieve the financial objective of the entity. Full stop. You see how nice it is? I think it's not difficult. Of course, you cannot manage mango and expect to be doing well in pineapple or orange. Yes. Unless you have a balanced management. And then we move. All right, so now to do this, we have to go through the procedures, the methodology that we have to use in order to achieve this is what we are going to look out for now. So first, we have to learn the steps in the financial management. So when we talk about this, we go through the steps one after the other. So if you want to probably achieve a financial management, what are the steps? Here, the objective is to maximize the shareholders' wealth. You see, this objective is what? Shareholders' wealth maximization. That is one thing that we have to take notice, even though we'll get to know more. All right, so from here, we move on to what do you call the steps or the stages in the financial management. So let us examine the steps involved. So the steps involved in managing our finances. So first of all, it starts from financial planning. So we start from financial planning. So that is where we normally start from. So what is financial planning? Then we'll go to financial controlling and now move on to financial decisions. So when you say financial planning, what are we talking about? Planning simple means setting up an objective ahead of time, making decisions ahead of time. So planning is on deciding on what to do ahead, setting up objectives. You see, we have not yet entered into tomorrow and next month. So let's say next month, we are not yet there. But trust me, many people have planned for next month. They have plans. It simply means they have some laid down itinerary that they are going to pursue next month, even next year. Some even have plans for next 20 years. 20 years. They have plans for next 20 years. Especially nations, countries. You know, countries have a very long-term plans. No problem with that. So that is all we are talking about. Once you decide on something before, it's what we term as what? Planning. So if you want to have a successful financial management, then you must start from where? Financial planning. In simplest code, make decisions on your financials. So tell us that, next year I will spend 80% of the money on investment, 80% on investment, 10% on education, then 5% on food, 2% on other, maybe family, 1% gift and hospitality, the last 1% miscellaneous, maybe unexpected. So anytime someone calls, hello, I am in trouble. Please, can you help me? Oh, I'm very sorry. This is all what I have available. Try and manage it or else get some from elsewhere because my plan, my budget is very tight. Let me just 1% available. And you give that 1% out. What a wow. So that is a plan. So we have people that if you go to their they have a gift shop in their room, in their houses. Every year they have people that they gift. So anytime they are buying very expensive, nice stuff into their gift box. So whoever comes to their heart, they just go in there and then bless that person. That's their plan. You see, if you fail to plan, then you are planning to fail. So planning itself is a very good managerial tool. You can never learn any management on this earth without the word planning. talk about all management studies, planning is central focus. So planning simple means you know at least have a fair idea of what you are going to do tomorrow. Tomorrow will never come by surprise. Yes. Even though risks and uncertainty may disorganize your plan, but it's far, far better than live without a plan. Good. So that's financial plan. It's about setting up a standard. So financial plan can be setting up a standard. So making a decision ahead of time. So setting up a standard. It's about standard setting. So add it to it. It can also be about forecasting. All this, just looking into the future projections. That's all. So that is all about financial planning. So you must at least have a fair idea of your expenditure tomorrow, your receipt tomorrow, so that it will inform you how to live the life. If everything takes you by surprise, yes, it means that you can also lose money by surprise. Good, so take notice. Then the next stage is what you call financial controlling. So after you plan, you must control your financial. So we call it financial controlling. Here, basically, our financial control. Here, it's about taking steps to achieve your target. This one is also known as target. Yes. No wonder. Financial what? Control. With target, always your target is fulfilled. Financial control simple means you are taking reasonable steps to achieve your expectation, your goal, your objective, your target, your dream, your hope. That is all. So take notice of that, and then we move on. Just a second, friends online. Now, so the financial control is about what? Finding ways to achieve objective. So control simple means ways of achieving the objectives or the targets. So here too, it's about objectives, setting of objectives. I can add it to it, objectives. So here, in simplest case, is comparing. You are going to compare. Comparing what you call the standard with the actual results. With what? The actual results. With the actual results. With the actual results. You obtain variances and you take corrective measures when necessary. That's all. The word control simply means three things. Anywhere you meet the word control, there are three steps. One, Control in management studies simple means one, you set a standard for yourself. That's the plan. And then you compare, you measure the actual results. Compare the difference if there's variances. Then, in fact, here, the step 2 is the actual results. Work out the actual result. The last stage is what? You obtain variance and corrective measures. That's all. So when you're going to talk about financial controlling, these are the 3 steps. But because financial planning deal with the very first aspect of the controlling, so this is the financial planning, then the controlling now will be this. The last one is called financial decision making. Financial decision making, that's number 3. Financial decision making. Now, when you talk about financial decision making, here is about now deciding on the course of action, making choices about the course of action. That one is the actual. Yes. Here, financial manager have the main decision. There are 3 in number. So the main decisions are the main ones. Main decisions, they are one. In fact, capital budgeting decisions or investment appraisal decisions, or we normally call it investment decisions. Good. So call it investment. So as a financial manager, you should know the efficient way of investing companies' money. We can also say capital structure decisions, or you can also talk about what you call sources of finance decisions. Sources of finance. Number 3, dividend decisions. Now, these are the main 3. The rest that I'm adding are recently added. Number 4, risk management. Risk management. And then the last one is what you call working capital management. Working capital management decisions is very important. So these are the decisions, these are the 3 main ones, and then the rest have been added to it. So investment decisions are being made by the financial manager. Which asset they must acquire, which kind of shares they must acquire, and then the rest of the storyline. So we must understand all these areas, and then we move on with the storyline. Now, I'm done with this decision making. Now, you must know the difference between financial management, financial accounting, and management accounting. That one I'll give it to you as a trial work. to know how financial management. So let me start from the differences. So differences with other rules. And then the similarities. So this is what I want you to do for me. Start with financial accounting. Go with financial management. And go with management accounting. So what do you think will be the difference? List them here for us. So please copy and complete this table for me. Number one, tell me the objective of financial accounting. To provide information for decision making. So to provide information, yes, for decision making. So this one is provide how the entities were being. So you must know the difference between them. And here it provide information, historical information. So here, third examiner, that to provide what? Financial information to users for decision making. Financial management is to manage what? The financial resources to achieve what? A financial objective, you see. Then management accounting. The aim of man accounting is to provide information for planning, controlling, and decision making for managers. You underline it. Then tell me the type of information. Type of information. Financial accounting is only financial. It will record only financial information. Here to the same thing, financial. But here both financial and non-financial. You can talk about the users. Over here, financial accounting users both internal and what? External users. So anybody can use financial accounting information. The financial report here is available. They have published it outside. The general public can read these stories. But for financial management, it's only for internal, only internal use. Only what? Internal use. Any management reports are not meant to be outside. All management reports are not meant to be outside. It must be within the entity. So please, let's take notice of that. Again, the information that it provides. Here, it provides information basically about you can tell us the timing of it. Financial accounting provide only historical, only past information. Now, only historical past information. for financial accounting, historical. Only information about yesterday. But all the management papers, they provide information about one, past, present, and what? The future. The same thing applies to management accounting. Then let me ask you, what is the difference between management accounting and financial management? They are almost the same, but there's a thin line. So I'm done with these differences, and we move on with the game. All right, so the next section, we move on with the storyline. Now, right after this angle, we are now going to move on with what you call strategy and objective. Yeah. You see, we talk about the aim of financial management. Let me go and trace the roots. The aim of managing something is to achieve the objective you have set. Hey, if there's no objective, there's no aim, there will not be any need of managing something. An objective can be utilizing resources well. So where there's no aim, there's no need for us to manage anything. Of course, we don't have objective. So managing funds won't be an appropriate story to tell. Now, the next section is that we have to now tell objective. What objective? How is it different from a strategy? So before I start that, I normally have a very nice way of explaining this. Mission. What is mission? The purpose of existence. Purpose of existence. We call it raison d'etre. What is vision? It's the same as goals. Hope. Where do you want to see yourself in the near future? Where you see yourself in the future. In the future, will you be the market leader? Or you see yourself as to be innovator? Or you see yourself as to be motivational speaker? Or in the near future, you see yourself in a professional field like ICA, ACC, and CIMA? Or in the near future, you will be academician? Where do you want to see yourself? The future that we are talking about is not like 1,000 years future. We are talking about, let's say, even though it's a long term or medium term, we are talking about 3 years, 2 years, 3 years, 4 years out of us. Where do you want to see yourself? Yes. You see, Yamaha created some vision and mission that make it was very aggressive one. Yes, very, very aggressive one. You see, it was Honda. Honda created that particular vision when they were about to enter into US market for the first time. Those days it was Yamaha who was producing motors and bicycles. They were the leading producers those days in the United States. Honda coming from Japan said, can we go and beat them? And they set up a mission, a vision. The vision of Honda was very simple. to go to US, compete successfully with Yamaha, kill, crash, and bury Yamaha. And it was successful. And Honda started. And here we are, Honda Motors. Almost all national security on this earth have tasted Honda security motors. Even though Yamaha, in some countries, Yamaha produced their security motors, but Honda has taken over. So that's where you want to see yourself. That's the vision. Now, mission is unlimited. Mission statement is unlimited. It doesn't expire. There's no time bomb, even though you can review it. So, but for vision has a time limit. So mission is not limited by time. Mission simple means what you exist to do every single day. So the day that you don't do it, that's not you. Yes, that's not you. It's like a culture, your value, and everything. Then goals. In order to achieve goals, we now break goals down. We get objectives. So objectives are smaller performance targets in order to achieve your goals or vision. So in order to achieve a vision, there must be an objective. So objective, means of achieving goals. They are the means of what? Achieving goals. Then we have strategy or tactics. Strategies are also means of achieving objective. So you see how the hierarchy look like. So what is strategy? So strategy is the means by which entity achieve what they want, their objective. So that's the difference. So the goal is to be called qualified accountant. Then break it down into objectives. So first year, what will you do? Oh, year one, I have to get at least half of the entire papers must be worked with. The following year, I do the rest of the half. I'm done for the entire game. And then that is it. So let's take notice of that and then we move with the game. So basically, that is it. Now, strategy, in simplest language, means of achieving our objective. Therefore, strategy refers to long-term direction. So for strategy, it's what long, it's made up of long-term direction in order to achieve your objective and goals. Now, here we just have to know some few issues about them. We have what you call the corporate strategy, levels of strategy. With reference to Johnson, Scholes, and Whittington, we have levels of strategy. Reference to Johnson, Scholes, and Whittington. We have the corporate level strategy. Corporate level. We have the business level We normally call it strategic business units. The last one is called operational level or functional level strategy. Functional level. Strategy. We are done with the storyline. Now, what is corporate level? It's a strategy that affects the entire company, the entire organization, and is usually taken by the higher level, the top level management. They embark on what? Corporate level. As the name suggests, corporate, the entire company. It's not just one aspect. So corporate level, it affects the entire organization from head to toe. So imagine we target professional consult. Our corporate strategy affects every field of the organization. Then we now move on. That one is taken by the head, the board of directors. It's not taken by the middlemen or the regional managers. No, it's taken by the board of directors. Because that one is normally, that's what we call it, order from above. Then we move on to what we call strategic business unit or the business level strategy. When you say business level, it's how you compete successfully in a chosen market or product. It's about your product and market, that's all. You see? You may have different kinds of products and you may have served in different markets. You can't tell me that the strategy you use in product A will work for product B. So when it comes to target professional consult, the strategy we use to deliver our online classes for, let's say, financial management, maybe similar to the other management courses, but not the same as other non-management courses. Our strategy we use for ICA Ghana exams is not the same as the strategy we use for our degree students or our university students or even CIMA and ACCA. So each product or service that we render, there must be a unique strategy for that particular one. Imagine we serve in three markets: African market, Europe market, and Asian market. The strategy we will adopt in Europe might not work for us in Asian markets, might not also work successfully for us in African markets. So selecting a strategy that is unique and that is particular, designed towards that product or that market is what we call what? Business level. That one does not affect the entire company. That one affects only one aspect of the company. What a wow. Then the latter one is called operational level. This strategy is being developed by the middlemen or the middle line managers or the regional managers or divisional head. Then we go to what we call the operational level. These are strategies taken by the functional department, the functional heads, marketing, HR, production, admin. We believe that if a production manager achieves his target, his objective, his strategy, and production manager, HR, marketing, if all of these people achieve their objective or their target, their status, their strategy, if all of them have a strategy, it will work towards the business level. And the business level strategy will also work towards what? The corporate level strategy, so that we can be able to achieve the overall objective. I'm done. Now let me start with the objective. Now you're going to talk about the objective. As a financial manager, you must know the objective of firms. Why the company exists? And which of the objective is the best? You will definitely get a question on this arena. The objective of business and which objective is the best. So let's go straight to the objectives. Now we talk about objective. Objective, there are basically two types of objectives. We have the financial objectives. Then we have what? Non-financial objectives. The financial objectives, we have the main two, the two main ones, and we have the others. That's all. So when you say objective, objective are means that we achieve our goal or purpose. Objective is our aim, our target. What's the aim do we have in every company? What's the aim? What's the target? What's the target? What's the aim? Now let's go to financial objectives. So I'm starting with financial objectives. Financial objectives. Now, the objective relate to the key factors for business success. So here there are a lot. Now, the financial objectives, we can basically start from what you call the shareholders' wealth maximization. There are two, the two main ones are the two main ones. One, we have the, in fact, let me talk about profit maximization. Next, we talk about shareholder wealth maximization. In fact, let me be very honest. The second one is superior than the first one. And many examiners will always ask you, why is it so? They just want the importance of the second one, that's all. So why is the shareholders' wealth maximization is far better, far better than profit maximization? Just tell us the relative importance of shareholders' wealth maximization over the profit maximization. Take notice of this. It could be one of your exam questions. So let's start. Profit maximization, profit. Why? Profit maximization even though traditionally this has become the objective of every company, true of us, traditional. In olden days, the main aim to run any organization, business organization, is to make profit. Yeah, the aim is to make profit, to make profit, to make profit. See, in recent time, we have realized that no, this profit is not the best. What are the unique features that make this profit maximization a bit not superior? And that is what you have to take notice of. And all these are advantages of the one I'm going to explain. So this one is very, very, very important. You may be asked to compare the difference between these two types of what? Of objectives. So here, with this objective, the aim is to maximize profit. And it makes sense economically. Yes, it makes sense. But here, it does not make sense to a certain point. So let's see. Reasons why profit maximization is not the best approach. Write them down. Reasons why profit maximization is not the best approach. Let's go. Number one, I've talked about the profit maximization. Simple means avenues to increase profits. How do we increase profit? We cannot do that without minimizing cost. So an attempt to increase profit as the main objective of the entity, we must find avenues to reduce cost. Thank you. Now let me answer the question. Let me draw something here for you to see where we are coming from. Please, in exams, argue like the way we are arguing here. No. When there are three forms of business or three forms of business organization. So when a sole trader makes a profit, who enjoys that profit? So I want to make it three. First, when the sole trader makes profit, who enjoys that profit? Is the entrepreneur, the owner. The owner takes the profit home because he has set up the company alone or set up the sole partnership alone. Now, when a company, let me go to partnership. When a partnership makes profit, who enjoys it? Is the members. The members or the partners. What about the company? When a company makes profit, in fact, it is for the company. What? So, in fact, I told one business owner or a CEO that if you set up a company is an artificial human being. It's not a natural human being, it's an artificial human being, and it operates on its own. So it can make money on its own. So company is on its own. And when the company makes profit, it's for the company, it's not for the owners. Until dividend is declared, owners have in fact, they have no business with the entity. You see, when company makes profit and the directors come to conclusion that let's honor our owners and give them dividend. If directors have not declared dividend, the money is not for the owners, it's still for the company. And owners cannot, in fact, go to the entity with matches, cutlass, knife, guns, go and scatter the company just because they've not paid dividend. It will never happen. Or they've made a profit, they are coming for their share. We don't share company profit. Take notice. We only declare as dividend to the owners. So why owner have brought money, set up a company, have invested, shareholders have bought the shares, and you have made billions of profit and say this profit is for the company. Lie. So this method is not the best. That is why we are one of the main criticism of this method is that it only makes sense or it's only the best when the business entity is a sole trader or partnership. Count to how many sole traders are in a large stream. Which of the multinational companies are operating sole trader and partnership? Majority of them are company. So most of the business organizations in the form of company. So that means this method is not the best in the recent time. Because why would I form a company and make money and tell me that I can't come inside? It's not for me. It's for the company. Who bought that company? Who bought that company? It's not me that invested in it. That is how it has been made. So that is why, as a financial manager, you must select an objective that will promote the shareholders' wealth. So this method is not the best. The first criticism is what I've given you. This objective is not the best. The first one is what I've told you here. That's point one. Why profit maximization is not the best? Because when it is not suitable for business organizations such as company, and the reason being that when company make profit, it's not for the owners. The company and its owners are artificially distinct. Let me speak a little bit of law. In law, sole proprietorship and partnership, the owner and then the entity are one. So that is why sole traders, they have what we call unlimited liability. Sole traders have what? Unlimited liability. If any sole trader incur huge debts, the personal properties of the owner or the proprietor may be sold to defray the cost. So will be sold to defray the cost. So it's unlimited. So in law, the owner and a sole trader, in fact, the owner and a sole proprietorship is just one person. But that of the partnership is also the same thing. Yes. But company is different. A company is an artificial human being. Even though company, the only difference between a company and a human being is that human beings have a flesh, our skin, we have a skin. That's the only thing company doesn't have. Company does not have a skin. Company can move through their directors. Company can talk to directors. Company can sign documents through their directors. Company can consume. Company can slap someone. Someone can also slap the company. So at the end of the day, company is like a human being on its own. So company can operate on its own. So at the end of the day, does not probably support the idea that when I can operate on my own and I've made profit, say it's for you. The mere fact that you are financed doesn't mean that my profit belongs to you. That is how the company is also reacting. And shareholders will not be happy. If you're a shareholder, will you bring money again? No, I'll never invest again. If you claim that you're on your own, why can't you provide your own money when you are starting up? That's it. So now, point number two, why profit is not cash. That's point number two. Why we don't like, not that we don't like, why profit maximization is not the best. Number one, profit is not cash. You see, it's not a cash flow. Now, friends online, if I put cash and I put profit there, which one will you select? Profit, you're a businessman, and two things, profit and cash. Profit and cash. There's one topic that we are coming to learn. That topic, profit and cash, you can never achieve the two at the same time. That's why that topic came in. Now, profit and cash. Every investor, when they put profit and they put cash there, they will always choose what? Cash and leave the profit. Why? The reason being that you can never go to the market and go and buy things with your profit. You can't tell the market woman that, please, look at my P&L and my balance sheet. Hey, this year, I've made billions of dollars of profit. So please, I'm buying this computer worth $100,000. This is my P&L. Can you subtract the cost of the items and then get me my net profit? Adjust my net profit for me. If they don't beat you at the market there, they'll tell that you are accounting. In accounting terms, something is not right. But if you have made cash and you take the cash to the market, people welcome you. So investors prefer cash return, rather than, or to that of what? Profit return. Although cash is not a way of measuring performance. Take notice. So we don't use cash as performance. That's why it's not every rich person or a billionaire that have that kind of a healthy or good name. So that is, they say good name is better than riches, something like that. Good. Now the truth of the story is that cash, it can let you go far, but it doesn't give good name. Take notice. We don't use cash to measure performance. That one is, it's a disaster. Using cash because of someone's money, you say the person is what? The best or the good. No. It's go beyond that. So take notice of that. Another point where we would use to disqualify the profit maximization is that, in fact, the accounting profit can be manipulated. Manipulations. Take notice. And it's subjective. Manipulated, it can be manipulated. It is what? Subjective. Subjective. And it can be manipulated. Number 5. It's a short term. It's a short term objective. Please, if you're a business owner, I'm sure you may be thinking on how, when the next 10 years, where your business will reach. Meanwhile, the profit is just yearly. 1 year, when you get the profit, that's all. So after getting the profit that you want to achieve, what next? That's the question you must ask yourself. After getting the profit you want, what's next? So profit is on yearly basis, and short term, within a year, you get it, you are done. You now increase it again. Why can't you do something that's a long term? Cash flow is a long term. So take notice of that. And accounting policies may also affect that. I'm done with this. Now let me go to shareholders' wealth maximization. Shareholders' wealth maximization. Shareholders' wealth maximization. Shareholders' wealth maximization is the best, because that one, it talks about what goes to the owner of the company. So the wealth of the owner, and that's the best. Why? Just turn all the points you wrote now opposite or upside down. You get the reasons why it is the best form. Now let's go straight to the game. Now, when you say shareholders wealth, we are talking about what goes to the shareholder. In fact, another point that maybe you can add is the risk. It does not factor in risk. It does not incorporate risk into the scenario. So tell the examiner, incorporate risk. It does not incorporate risk. Shareholders wealth over here is just about what comes to the shareholder, you see. Now, with this angle, with the shareholders wealth here, we are interested in what comes, what belongs to the shareholder. Yes. So take notice. Now, the benefit of this objective is very important. Good. So now, here, the wealth that we are talking about, you must know the wealth. Shareholders' wealth are divided into two. Shareholders' wealth are divided into two. One, capital gains. So they are capital gains, or also called it share appreciation. And dividend. Share appreciation or dividend. So these two is the wealth. So every shareholder is so interested in the level of dividend that he or she received. So we are interested in the level of dividend. These two make our wealth. When you say capital gain, imagine you buy a share price, the original share price, the value was, you bought it at, let's say, $1 or $2 per share. Now, currently, the shares price is trading for $1 of, let's say, $1.8. The share is trading for $1.8. So there's appreciation, there's a gain of what? $0.6. So that is how much you have earned per each share. So that's a capital gain, appreciation. The share price have gone up. What if from $1.2 now it has reduced to $0.8? That one you are losing $0.4 on each share. And this is what we call it at what? Shareholders' wealth. Now, if that year they have declared dividend or they have distributed dividend, you add it to it and then you are free to go. And then we move. Okay, so there'll be a question in here. Now pick a question straight from the material so that we don't. And then the calculation. So now the shareholders' wealth. It's not equal to. Now the capital gain or share appreciation is equal to, let's say, P1 minus P0, or current price, the current share price minus the previous share price. Now plus the level of D1, the dividend that they paid, or D0, the current dividend. So that's the formula. This is a shareholders' wealth. This is a value. This one is a value. Then as a percentage, is equal to the P1 minus P0, all plus the level of dividend, all divided by the P0 times 100. So that's the worth. So we'll be calculating a lot of them right now. And we continue with the storyline. All right, so now let's move on to the next question. Let me see if I can get question from our notes, our material. To do justice with. All right, so let's do this question together. So let's go. A shareholder purchased 1,000 shares in a company on 1st January at the market price of $2 per share. Then on 31st December, the shares had ex-dividend market value of 2.82 per share. The dividend paid during the period was 0.27 per share. What is the total shareholders' return? Now, when they say return, mostly is in a percentage. So the return, so the one we wrote here, the returns are mostly in percentages. So this one like this, the return. Good. Returns are mostly in percentages. What are the elements of the total shareholder return? There are only two elements for now. Your share appreciation, that's the capital gain, and then the rest. Your capital gain, and then the rest. Now, so to calculate this, what do we do? First of all, we'll code the formula. The more I code, the more I remember. The shareholders' return is nothing but shareholders' return the more I write, the more I remember. Current share price minus the P0, all plus the level of dividend they paid divided by the previous times 100. In this case, what is the P1? What is the P0? What is the D0? Let's just go and bring it up, fish it out from the question. The current share price is what? 2.5. And then 2.8 is the the current is 2.81. The original share price. The previous share price. You see, how do you find percentage change? New minus old, all divided by what? By old. That's the same storyline here. So 2.5, 2.82. And the dividend is 0.27. So let's plug them in quickly. So now it's equal to 2.82 minus 2.5 plus 0.27, all divided by 0.25, no, 2.5. Times 100. This is what you get. You can do the breakdown for me. 2.82 minus 2.5 is equal to 0.32.
0. Yeah, 0.
Good. So now the capital gain is 0.32 plus the level of dividend they will declare. Now that gives us the total of 0.25. Now the total of 0.32 plus 2.7, that is 0.59, right? So now the total of the total return, the value is 0.59. Now finding expressing this as a percentage, we divide it by what? 0.25. Please, next time you can just go straight forward. I only show the breakdown to reflect the impact of these two. They are separate, they are two things unrelated. So what do you get as a final answer?
Um, 236.
Good. So 236. No, in fact, I have key in a wrong. This 2.5. So I have to repeat it here, 2.5. So that one should be 2.5 throughout. So let's go 2.5. So it should be 2.5. 2.5.
That's 23.6.
All right, so 23.6%. Now this 23.6%, at the end of the day, we'll be asked to do the breakdown. This the total return. The total return, don't forget that total return can be divided into two. The capital gain, gains on shares, and the dividend. So we can express this. So let's do that. The breakdown. The breakdown. So you can express what you call gains coming from the capital gains only the capital gains is equal to the P1 minus the P naught, all divided by P naught times 100. And that one, you know it already. I could go straight forward to the game. 2.83 minus 2.5 all over 2.5 times 100. Give me the answer straightforward. Then the dividend, I'll give you its right name. It's called the dividend yield. The right name is called dividend yield. Is the cost of equity. In the near future, we'll call it cost of equity. It's equal to the dividend they are paid. So the D naught over the P naught. And that will give us so that should give us something like dividend of 0.27 over 2.5 times 100. So what do you get for the 2?
Okay, the first one I get 13.2.
Oh, so 13.2% versus
10.8. 10.8.
good. So that'll be 10.8. Then you put the two together. So putting the two together, you can run this one to 2 decimal places. So you can get the answer clear. Putting the two together, you must get the same total answer. Now we can say that this is 24. Let's run all of them to the nearest whole number. So imagine I should round everything. Here will be 13, here will be 11, making 24. 23.6 is also 24. We are done. We've achieved our aim. All right, so we have the other financial objectives. So let's go to the other financial objectives. Now, the other financial objectives are the earnings per share growth and the rest. So let me list them for you. Other financial objectives. Please, what you have done today is very important too. Very important, Rough. One is earnings per share growth. You must know the formula for earnings per share. Number two, the other ones you can talk about. The gearing, profit, returns, those ones. Gearing is the next one. Can talk about profit. Can talk about ROCE. Can add profit margin. And then the rest. There are many, I can't stop. In fact, when you say financial objective, anything in the P&L, listen. Anything in the P&L. Anything in the P&L or the financial statement. Now, let's tackle the earnings per share growth. Earnings per share is equal to profit after tax minus irredeemable preference dividend, all divided by number of shares. And then the growth, earning per share growth is equal to the current earnings per share minus the previous earnings per share all over the previous earnings per share times 100. That's all. We are done with the storyline. So let me pick a question for us to solve on the earnings per share issues. Okay, so let's solve this question. Example 2.3. Now it says that Waterwall Carpets made profit before tax in 2018 of $9.32 million. Tax amounted to $2.8 million. The company's share capital is as follows. Ordinary shares. It has 10 million ordinary shares at $1, which gives us a share capital of 10,000 in ordinary shares. Then 8% preference shares. That probably gives us 12 for 2 million. Calculate the earnings per share for 2008. So you go to the formula. The more you go, the more you remember. Now, instead of them giving us profit after tax, they give us profit before tax. And they give us the tax, so we can go ahead and subtract. We can do the mathematics ourselves. You shouldn't worry. Finance comes with mathematics. So we cannot tell the examiner that profit before tax. So we are calculating earnings per share. Now let's go back to the question. Let me pick the few details. It's 9.32, okay, and 2.8, good. 9.32, and then tax. Less tax, 2.800. So this profit after tax. Let me go to my calculator. Now 9.32 less 2.8. So that is 6,006.52. I have to be very careful here. The figures are in 3 zeros. It's in millions. So it should be 2.8 million. Six comma 520. So that's antipath. Then you say less what? Irredeemable dividend. Irredeemable preference dividend. Let's go and calculate it. It will be 8% on the value. So 8% on the 2 million. So 8% on 2 million will be 160,000. I know that they will take it off. They will tell the examiner. So 6,000, 360 million. So 6.36 million. And then we move with the game. Number of shares. What's the number of shares? It's 10 million shares. So therefore, earnings per share will be 6360,123 all over 10,000 or 10 million. You get an answer called dollar of 0.6360 or 63.60 cents. I'm done with the computation. If you have a question, you ask. Now, we can also have the growth. The growth, they have to give us 2 different periods, 2 different years. So we have to take the growth. And then we'll move on with the game. So maybe I'll pick another question that has the growth. Let's take grasshopper. So for that one, you are going to try that. Please, I have to give you something to do for me. So example 2.3 talks about grasshopper. And you have to do that for us. He said that grasshopper made earnings attributable to shareholders of $8.25 million in 2018. and $8.88 million in 29. The company's share capital was 12 million ordinary shares of $1 each. What calculate the earnings per share for 2008 and 9 and earnings per share growth in relative and absolute terms. Please, relative means monetary terms. No, absolute means monetary terms, and relative is a percentage. So take notice. Relative is a percentage, absolute is just the real figures, the amount, the difference. Now, all what you have to do is that calculate the earnings per share and then extract the difference for us. So here we can still compute it. Let me see if I can compute it here and move, because it's not that plenty. 2008, 2009, earnings per share, profit after tax over number of shares. Here was the profit. 8.25 million. 8.25 million. All divided by 12 million. And the following year, they had a profit of 8.88 8.88. The 8 are 3 in number. Over 12 million. Then you find the difference. So over here, $0.6875. Then here will be 8880 divided by 12,000. $0.74 per share. What's the growth? So calculate the growth for us. Now, absolute terms is the difference. Relative is a percentage. So do what, and then you do the needful. Absolute terms and the relatives. So relative is a percentage. Absolute is the difference. So find the difference between these two. That becomes the absolute. So this one is the absolute growth. Relative, you divide the answer by the previous, finding the expressions as a percentage. And we've done that already. So we are through with this. Now the rest of the story will be in a form of discussion. So we are going to discuss. All right, so on that note, we move on. And in fact, the earnings per share, usually have the same problem with the profit maximization because we use the profit to do the computation. Take notice. This earnings per share have the same difficulty, have the same disadvantage, the same as what? The same as the profit maximization. Even though one of their good news is that earnings per share is a performance measurement indicator. We use earnings per share to measure your performance. Yeah, so that's the good news that we can say about the earnings per share for now. All right, so we are done. Now let's go to the non-financial information. The non-financial information. And then we move on. Non-financial information. These ones are very important. So you see, I always say that the financial information does not depend on its own. With reference to what you call Kaplan and Newton in the balance scorecard, you see, money is not on its own. It always has its roots. So one, there are things that drive money. There are things that they are on their own, the non-financial. So in the recent or contemporary management studies, we always advise that a lot of work must be done on the non-financial aspect. And if your non-financial aspect is great, your financials will be more. So what are the non-financials? We cannot express them in monetary terms, but they are the hardcore. One, the welfare of your employees, very important. Hey, if you don't treat your employees well, they will also give out their best. Because something self-pay in business management, self-pay, the entity will be paying themselves. Instead of them come to watch the machine so that the machine will not cut or will not produce defect products or goods, they will be turning their back to the machine, or they won't do the work from the bottom of the heart because their welfare is not being compensated, not being treated well. So that's why I see a lot of defects of products. Or maybe at night, the person was sleeping at night, or sleeping at daytime, or not even supervising the machine to do the good job. So at the end of the day, you have a lot of defects, and company loses because if you don't pay us well or if you don't treat us well, we also have a very funny way for you to incur. And maybe this defect, sometimes when it comes, they give it to employees. Yes, the defect when they bring the reject ones to the company, it's the employees that they take it home. So if our welfares are not being taken care of, we can rely on this defect to compensate ourselves very well. So welfare is very important. It gives quality products. It's also part quality product and services. You see, if you want to be known everywhere, stand out and produce something unique, something quality. All depend on your employees. If your employees are highly motivated, quality will always be achieved. You don't need to have a strict issues with them because they are highly motivated, because their welfare is being taken care of. And when product quality is high, quality is number two. Customer satisfaction and customer retention will also be high. The rate at which you retain customer depend on the service you give it to them, the product itself. So all these are non-financial factors. It's very important. Very, very important. Provision of service quality and fulfillment of responsibility towards customers. Yes. Some of the organizations don't think about their customers at all. Hey. Anytime they don't have supply, customer will order for goods. And you will not tell the customer anything About 2 days later, you now send message to the customer that we are sorry, the goods, we don't have some in supply. I said, but I ordered it last 3 days. Me, I thought you have even processed it. It's even on the way coming. What? We are sorry, sir, we don't have some. Either you take it, either you keep it cool, or go and look for some elsewhere. When you get some, that means you are throwing your customers away. Where you get the money? So fulfillment of customers' orders is very important. The lead time. You go to a restaurant to go and then get some food at the lunch. You only have 45 minutes up to an hour to spend there. You get there, you order for food, they say, oh, wait for us to eat the food. We are just microwaving the food for you. You sat there, 30 minutes, they are not done. You say, what? Why? Are you recooking everything from the scratch? So if you go through all this, it means that customer patronage will be very low. Forget about the financials. You see, all the financial objectives we have done, if these non-financials are not being placed well, forget it. Forget it. Yes. Just forget about the financials and do a good job. A good job will bring the money. And then fulfillment of responsibility towards suppliers. Yes. Suppliers say pay is money and you are dodging. You think you are the smartest company ever. Suppliers will come and supply you goods and then you are not complying with their terms and consideration, their terms and conditions. They say buy from us, don't buy from anyone again. If you want any extra goods, tell us and you are buying elsewhere. Fulfillment of suppliers' condition. They know a day will come, you will be needing goods. You may even have fiscal money, but they will not sell to you because they know that you don't fulfill their terms. And then that is the storyline that we want to create. There are many out there. And then the society, welfare of the society as a whole. Yeah, that's a corporate social responsibility. Society as a whole. Yeah. So we take notice of all these ones. I'm done. I think I have a question here for you. I have a question. Yeah, it's in the book. It's in the material. So I will just test you the question number. You try for me. Now there are stakeholders in the and let's go to stakeholders. Stakeholders analysis. So stakeholders, these are the parties that the entity's activity affects directly or indirectly, or parties that they have interest in the entity, direct or indirect. Any of this is a stakeholder. So, and for that matter, in fact, we must know their interest, all the stakeholders' interest. So that is that. And these stakeholders we are talking about, we can group them into what? 3. Internal, external, and connected. Who are internal employees? Hey, I've even mentioned it. Who are internal stakeholders? Employees and managers. These are internal stakeholders. So for internal stakeholders, they are what? Employees and managers. And it includes pensioners. All of them are internal stakeholders, pensioners. We have the connected stakeholders. They are connected. They are not internal, but they are connected. They are linked. Normally, those that provide the finance, take notice. Those that provide the money to the entity. Number 1 is the shareholders, debt holders, bond holders, customers, bankers, suppliers, and competitor. All these are what? Connected. And then the external. External stakeholders are government, pressure group, local and national communities, And then the professional and regulatory bodies, all these are what? They are external factors or external stakeholders. So these ones, I don't need to write them. We can probably go through them and then. You must know their interest. What I want everyone to note, to get or look at it careful for me is this. Each of the stakeholders, you must know their interest. And how does it conflict with another stakeholder's interest? There's a lot of conflict between the individual interest. So the idea is that we must always know the interest and then how does it conflict with the other people or other stakeholders. Each of the stakeholder group have their own objectives. Those ones, you must look at it for me. So I can maybe list some stakeholder here. Their interest. Good. Let me do it this way. Now let's go. Oh, my board is full. Okay, so let me clean this side like this. You see, the stakeholder you're talking about, you can say objective or interest. So you can say shareholders, what's their interest? To maximize returns or wealth or dividend. Or shareholders' wealth. Then what to be the conflict? Conflict with customers. Customers want a very nice and lucrative salary. But if they use all the company's profit to pay salary, which one would they be available to pay dividend? Don't forget, you must pay all the salaries before we pay dividend. And here we are. Employee salary must be paid before dividend. So at the end of the day, it creates a conflict. You see, managers try to reduce. Managers try to reduce the expenses by cutting down salary at the expense of the employee's pocket in order to pay dividend to the owner. So there are more conflict of interest within the game. There are a lot of them. Now we can talk about the agency relationship. That's the corporate governance style. That's like agency theory. Yes, we can look at them. But I want you to complete this table for me. I think I've done some table B in your material. So potential shareholder interest and conflict. Yes. So potential, these are the tables should look like. Then the conflict. So let's just assume that shareholders and employees, what will be the likely conflict? Customers and management. So you tell us all this stuff, then we move on. All right, so basically, that's all. Then corporate governance stand, maybe I may do a round table discussion for corporate governance and then the agency theory and those ones. Let me treat them right away. I need a board, whiteboard. Let me clean some parts. Now let's go to corporate governance and agency theory. So let's assume that this is management. Yes, owners. Or shareholders. And then here is the board of directors. That is all. Now, I have a very nice question, nice way to explain corporate governance. What is corporate governance? It's how we control and direct an organization. Please, corporate governance goes beyond management, mere management. You see, anytime ownership and management are in different hands, it creates that. So, corporate governance normally must be enhanced when ownership and management are in different hands. So, here shareholders, they have appointed agents. So this one is principal. They have appointed agent. This is the agent. And these ones are called stewards. So if you have heard of target triangle of corporate governance, that's what it means. Now, and these are the actors of corporate governance. So you must know what the shareholders, they do, board of directors, and then the rest. Shareholders, their main role is in the form of approval. They approve decisions made by the board. But their main role is make decisions, policies, supervision. Management is about implementation and safeguarding the assets of the entity. These three of them coming together made up of what? The corporate governance issue. You see, anytime management of a company and ownership of the same company are in different hands, then there'll be a need for what you call agency theory. It creates what you call agency relationship or agency theory. Agency or relationship is a relationship that exists between the shareholders and then the directors, those that manage the entity. So between shareholders and then the directors, that is where we have the agency relationship. So agency relationship is coming from where? Agency theory. And then that is all. Agency relationship, agency theory. Now, when management and ownership are in different hands, what do you think will be the problems? There will be a problem. There will be one conflict of interest will arise. Conflict of interest. In a sense that the directors will now start pursuing their selfish interest without pursuing the interest of the shareholders or the owners of the firm. Someone have called you to come and manage his business for him, and now you are there looking after what you will get, not what the owner will get. So at the end of the day, the purpose at which you were called might not come to bear, and it's worrying them. So this conflict is called, to formalize, we call it agency problem. Agency or problem. An agency problem exists as a result of what? Agency relationship. Agency problem exists. So when ownership and management are in the same hands, example, Makola woman or the local trader, the woman that buys and sells, the shop's owners, those teams, they own and manage the shop by themselves. So here there will not be any conflict of interest because she's the owner, she's the manager, and there will not be any agency problem. There will not be any agency problem. You will never have any grudge with anybody. The only people that you may have grudge with is the customers, not any owners are sitting somewhere. And then that is all. So what causes agency problem is a conflict of interest. Now, as a result of agency problem, there's what you call agency cost. Is the cost of what? Protecting the interest of the shareholder. Cost of protecting and losses suffered. So that's agency cost. It's made up of three things. Three different costs that come together to form what you call agency cost. Three. three things. Number one is now reporting, financial reporting and auditing cost. Financial reporting and auditing cost. All these are agency cost. The next one, you see, why are we saying financial reporting is an agency cost? Because Makola woman, a sole trader, that's not required by law to prepare financial statement. So a sole trader doesn't think about auditors. They don't think about auditors. Sole traders don't need to worry themselves about account preparation. Only in a few situations where they may require to produce some statements. So sole traders are not necessarily required to have auditors and co. So that is it. It's because the owner and the manager is just one person. That is it. Auditing cost. The cost that shareholders incur to protect their interests. One of them is auditing cost. Number two is the cost that shareholders incur in protecting their interests, like executive share options. Cost incurred to protect shareholders' interest. The last one is what we call any losses suffered by shareholders as a result of bringing an agent in. So if the agent take the wrong decision, it may affect your shareholding. If agents take the wrong decision, managers and directors have taken the wrong decision, and therefore the company have lost money, it normally go against shareholders. Shareholders have the long run effect of all these mistakes. Then what are the ways of correcting this? The ways of solving agency problem. Number one, ways of solving agency problem. So here you normally give tight reporting controls. Reporting controls. Number two, you award what you call performance related bonuses. Number three is what you call executive share option. All the executive directors give them share. and then the rest. So I'm done with this. Now the next work I'll give is to, you are going to, it's your trial reading work. Please work on this. The regulatory bodies, their functions and objectives. So know one, the objectives of the following bodies. Number two, this is for ICAG. In fact, this one is for all. You must know objective, but I'm not read there yet. Objective functions, their role, and then their actions on the financial management of an entity. That's all. I'm done. Now, who are they? So for ICA Ghana, this is both all professional level, ACCA, SIMA and Co. ICA Ghana, you must know the role, objective, actions of Bank of Ghana. Over here, no World Bank. And then number two, SEC, Security and Exchange Commission. Here, no IMF, International Monetary Bank. Number three, National Insurance Commission. Then number four, National Pensions Regulatory Authority. And this one, please take notice of them. You get questions on them to answer. Let me see if I have. All right, so that is that. Let me bring some questions out for discussion. Yeah, can we go on a digital page? I'll see you there. All right, so these are the questions there for you. Now you can answer all questions in this. And it's your question one, always. I want you to just try and answer on question 18, 19 or so. I don't know what is there though, but let's go there. All right, so let me go straight. Look at these questions for me. Good. So these are the ones I want you to take notice of. All right, so if you have any question, can you ask before I bring today's edition to a successful end? And I will see you when I see you go in the next week to do the second chapter. So I did the first one we have done justice to it. Then we'll do the next chapter, the syllabus content. Maybe after this we may look up for time value of money next week and questions of. All right, any question before I close the chapter of today's edition?
Sir, please, will the video be available for maybe playback?
Oh yes, all the classes. You go the same place, you see the new videos, and then but today's one, I think I'll upload it tomorrow afternoon. I'll upload today's class tomorrow afternoon. All right, any question for me? More questions? All right, so if there are no questions, then this is how far the good Lord bring us. My next meeting with you, are doing time value of money. You cannot afford to miss that time value of money. We'll put it there. Thank you very much for coming. If you have a question, kindly ask. Today's our very first topic. We've summarized it. Then you have the material. Please read more of the material, solve questions. I have over 20 questions for you, and that 20 questions in it, I say select one. Last thing for those who wrote, please check the material uploaded there. You will only see the iota of the question they ask you in it, and you are free to go. All right, so I may end here. Please, if you have last sentence question, please upload it on the page so that everybody see it. Scan it, put it on the page, our WhatsApp page. That's the FM page, not the general page. Okay, so that is that. Any question before I call off a class? More question?
Please. No, please.
Okay. Just today your internet is it was worrying you, fluctuating up and down. Okay, so all right, so good night. Thank you very much for coming. I want to see you going next week. Have a nice evening.
You too.